Well, hello everyone, and welcome back to Saylor Academy's MBA 601. We're going to be talking about Unit 2 today. If you haven't seen our previous two Unit 1 videos, they should be in a playlist below. And of course, this is all about Saylor Academy's course, so it's important that you check out the course to get the full details of what's going on here. But I'm just going to go ahead. I'm feeling good this morning. I'm just going to go ahead and hand it over to Dr. Pearsall to get us going.
Great. Thanks, Michael. And hello again. We will be talking about Unit 2 in the financial course in our MBA program here at Saylor Academy. If you recall, there are 7 units in this course. And in the first 2 presentations in this series, we discussed managerial accounting and financial accounting and the implications of both. We want to turn now to doing a deeper dive into the financial statements and particularly how we can use those to analyze information. As you saw from prior presentations, there's a lot of detail in those statements. We want to spend a little bit of time talking exactly what we do with it. Now, we had discussed that each of our courses has certain learning objectives. For Unit 2, the 2 that apply here are 1, the ability to explain the financial package, including all the different statements in it. We went into some detail on that in the last lecture. And more particularly today, the ability to apply the results that we have to conduct an analysis, and more importantly, to use the analysis. What's the purpose of doing all of the math that I'm going to share with you today? In particular, for this Unit 2, our learning objectives are going to be the ability to calculate various financial ratios. Now, we're going to see that there are a number of them. Now, we're not going to go over all the potential financial ratios. We'll highlight a few key and commonly used ratios so that you get a sense. The good news is there is tons of information, and in our course, we provide access to lots more material and ratios that you can gain from the financial package. We'll talk specifically about the evaluation process, evaluating the firm's performance, both over time and also, importantly, how we stack up against other players in the industry, whatever industry silo we happen to be in. And recognizing areas where we're not meeting expectations, we're not meeting the budget or the forecast, or there's simply areas where there's opportunities for performance improvements. Now, in topic 2, in Unit 2, we have a number of topics that were covered. Common sizing is something we talked about in the last presentation, and we had examples and demonstrated that basically it was taking the financial statements and restating those as ratios, showing, for example, cost of goods sold as a percent of sales, so that we could get a better sense of direction and performance. Well, we're going to get into very specific ratios today. We're going to talk about profitability ratios. Profit is certainly a key component of every business, and so we spend a lot of time focused on profit. I want to talk about liquidity and operating ratios. We'll also talk about debt. Most businesses will carry some degree of debt or leverage to maintain their operations. So let's take a look at those ratios. Market value ratios. This is really an indication of how well the firm is performing, at least in the eyes of the outside marketplace. And then we'll talk a little bit about comparative financial analysis and trend analysis and benchmarking. Now, before we dig in and start calculating ratios, let me just take a moment here and see if anybody has any immediate questions. Great, thank you. All right, let's look at the whole concept of financial statement analysis. We talked about the fact that we typically, when I got and received the financial statements, say quarterly and on an annual basis, one of the first things I looked at were the common size statements. Again, that simple calculation of showing each item on the statements as a percent for example, on the income statement, the revenue line. Um, by analyzing these statements, we can hope to get a much better understanding of exactly what this firm is doing in terms of generating profit, we hope. What is their status on liquidity? And what about the controlling the operations, which consume a lot of time and resources in most operations? And we want to talk about how these ratios help us to make decisions. One of the key responsibilities of management is deciding things on product offerings, on costs, on the use of resources. So we're going to find that we can go into these statements and determine an awful lot about how our business is doing. So let's start with profitability. Now, just to make it a tad more complex, we're not going to talk just about net profit. Net profit, of course, is the bottom line. All right. So if you look at an income statement, you can take the revenue on the top, total income, subtract all the expenses, including any taxes, and you wind up with earnings or the net profit at the end of the statement. Well, we're going to take that statement, we're going to break it into a couple of component parts because we're going to see that there's some implications here in the decisions management is making and its impact on that bottom line. So let's start with the idea of gross margin. Now, gross margin is going to take a look at gross profit. So let me go back and remind everybody that on the income statement, we start with the top line, which is income. The first thing we take out of income was the cost of goods sold, or COGS. That basically is the materials and labor that the businesses use to produce the products that are being sold. The difference between the revenue and COGS is the gross margin. Now, what we want to do is just like in common sizing, we want to turn that into a percentage. All right. So we know, for example, that I applied some numbers here to make these ratios a little easier to understand. We can see that our profit was $1,236,000. Our revenue was $7 million. Okay. So we can see that there was a dollar amount of profit generated in the firm. But what is that as a percent? So I can start comparing it to future performance, past performance, and even outside our industry. Our gross margin, which is the gross profit divided by revenue, and we're going to multiply that by 100 so that we can generate a percent. All right. And that's 17.6%. Now, again, for comparison purposes, I put some numbers up there and said last year, let's suppose our profit, our gross margin was 14.6%. So what's that tell us? One, it tells us our gross margin has improved. It's gone up a bit, meaning we are in fact more profitable. Specifically, what does the 17.6% mean? Think of it this way. For every $100 that we generated in revenue, we spent $82.04 on cost of goods sold, which left us with a gross margin of $17.60. Now, is that good, bad, indifferent? And the answer is I don't know. We'd have to see what was the plan, what was our target for a gross margin at this point in time. If it was less than 17.6%, then we've at least exceeded our target. I don't know if that means that it's a spectacular performance yet. There's a lot more analysis to do, but at least we're starting to think about what's happening. Now, more important, I said that we use these ratios for decision making. Well, what decisions can we make at a very simple level? Suppose that you're looking at the 17.6% and saying, we really were looking or shooting for a target of 25%. Well, there's two things that you can do here. One, keep costs the same and increase sales. Or two, you can reduce the costs. Right. And so perhaps as that decision-making process, this might be one of those things I'd make a note of and say, well, obviously the cost of goods sold is still too high to generate the profit target, the gross margin target I'm looking for. So let's consider some things that we can do to have an impact on that cost of goods sold. Remember, I said that they comprise of two basic components, materials and labor. Well, Could we get together with the purchasing operation and see about initiating a project to locate additional suppliers, negotiate prices to a lower cost, consider things like quantity discounts? And are we being a careful steward of the use of human resources? What does it look like for the number of people we have working in the operation? Are we heavy in that area? Is there an opportunity to become more effective with training the employees, make them more effective, more efficient, thereby produce more, lowering the overall cost? All right. So if you're getting the idea that we can do a simple ratio and then turn that into a substantial meeting, you're right. That's exactly what we do with this analysis. But let's not stop with just a gross margin. Remember, we're only two lines down on the income statement. So let's go to the operating margin. The operating margin is the margin that comes below the what we just talked about when we talked about the gross margin. Remember, gross margin is revenue minus cost of goods sold. Now what we want to do is we want to go below that line and take out additional expenses, typically SG&A. All right, sales, general operating expenses, and administration. And that's going to give us what our operating margin is. Now, this has not taken us to the bottom line yet, all right, but we're almost there. So what's our operating margin? In this case, again, we're going to look at EBIT. And if you recall from our lectures for Unit 1, EBIT is the earnings before we pay any interest or taxes. All right, so it's all the expenses except for interest on debt and taxes that are due. And we're going to divide that by revenue, multiply it by 100, and we find our operating margin is 7.1%. Now, last year, let's assume it was 0.3%, very low. So on one hand, significant improvement, at least against last year. I don't know what that shows yet for the market. We haven't gone outside the doors yet. We're still looking internally. But what does that mean? It means that for every $100 of revenue that were generated from the sales of products and services, there was $92.90 spent on expenses. Those expenses now include cost of goods sold plus SG&A. And what did that leave the firm? It left us $7.10 in operating margin. Now, again, an improvement over last year. We probably would go back and look at the past few years. We'll talk about that more later in this presentation, but you're starting to get the idea. Again, if the 7.1% is lower than expectation, well, we've got a place to start to look. And that probably would be going through the detail expenses that are listed under SG&A. The selling expense, the cost of administration, marketing programs, and other operating costs. Let's take a look at those. And remember, in terms of a business, one thing that I found over being in business many, many years is that we continually focus on cost management. I don't know after 30 years in business as an executive, if at any time I said, you know what, we're really good, don't worry about costs, go ahead. We always concentrate on evaluating costs just to ensure that there aren't opportunities to have a direct positive improvement on the results of the firm. All right, so that's the operating margin. And now let's get to the big one, which is the bottom line, the net profit. The net profit is the last item on the income statement. So after revenue, taking out all expenses, this time including any interest payments we make and any taxes that are due, that's the net profit, also referred to as earnings. All right, that's the bottom line. Our net profit margin for the current year is 3.6%. Last year was a negative 1.6. Now, I'm showing negative numbers for the prior year so that we look at this and say, well, we've improved. But as an executive, I'm here to tell you that because we did better than the year before, doesn't mean that we are either meeting expectations or actually achieving all that we should. One thing that I mentioned probably more often than anyone wanted to hear in an executive review meeting was, I know what the number is. My question is, what should it have been? And that's a much harder question to answer. What should the margin have been based on the economy, the marketplace, competition, our products and services? But it's a question that we should spend some time on if we're really going to be effective and efficient in managing our businesses. Now, the 3.6% net profit margin here means that for every dollar of revenue that we generated by selling our products and services, we received about 4 cents in bottom line in the net profit margin. Now, that sounds like a small amount, but if you're talking about millions or tens of millions or hundreds of millions of dollars, that can be substantial. But again, is that sufficient for what we're trying to do? Is that sufficient for the firm, for our investors, and for our shareholders? Okay. Now what I want to do is go to another area for some ratio analysis, and we're going to look at liquidity. Now, if you remember from our presentation last week, talked about liquidity, meaning how liquid is the firm. Liquidity is the firm's ability to put their hands on cash to meet obligations or operating expenses that come up. We looked at the balance sheet, which is where these ratios are going to come from. So now from the income statement, we're going to go to the balance sheet. Assets are things that the firm owns. They have value. All right. They're worth something. But remember that we divided that balance sheet into two parts. We had current assets and we had non-current. The current assets were those that we could reasonably expect to turn into cash within the next 12 months. So that's liquidity. And certainly suppliers and creditors are going to be interested in exactly how liquid the firm is. In other words, what position are you in to be able to access cash to meet certain obligations that the business has? Now, we're going to look at two liquidity ratios for our purposes today. We're going to talk about the current ratio, which is sometimes known as the working capital ratio, and we're going to look at the quick ratio. Now, remember, working capital, that's the amount of money that the firm has that they can use in the day-to-day operations of the firm. So let's look at the current ratio. Current, because we're going to look at current assets. Now, we're not looking at the long-term assets because they're long-term. They're not very liquid. It could be years in order to convert plant and equipment, for example, into cash. So let's take a look at current assets versus our current liabilities. And remember that current liabilities are those liabilities which are going to need to be paid in the next 12 months. So current assets, current liabilities. In this case, our current ratio is 2.58. Last year, that current ratio was 1.46. Is that good or bad? Well, let's make sure we understand what it means. A current ratio of 2.58 means that for every dollar of liabilities, the firm has $2.58 in assets that can be used to cover those liabilities. Now, here's the interesting thing. Obviously, the higher the number, the higher the current ratio, the better the firm is able to cover any liabilities they have. However, if that number gets too high, it's not good for the business. Why is that? So let me confuse you a bit more. If that number is too high, it means that you've got lots of money tied up in assets. And remember the first purpose of the firm. Investors, owners, shareholders put money into the company. They gave you money so that you would invest it to increase their return. If we're sitting on too many assets and perhaps not generating a big enough return, that isn't necessarily a good thing. And that's why we monitor and we look at these ratios and we keep asking ourselves the question, is this good? Does it need to be improved? Does it require additional attention from us? Now, last year, I said it was 1.46. So we've obviously made some improvements in either lowering our liabilities or increasing our assets. And again, the final question, are our current assets working for us? And we're going to talk about that in just a few more slides. The other is the quick ratio. Now, this is an interesting one because what this says is we want to take the current assets that we just used, but we want to take out the inventories. Now, remember when we reviewed the balance sheet in the last lecture, we said that inventory is an asset. It's a product ready to be sold. It has value to the company, but does it? The question on inventory that particularly lender will ask is, how liquid is that inventory? Is that inventory that's turning on a regular basis? We're selling it every day, every week, every month? Or do I have an excess amount of inventory that may have been sitting in stock for an extended period of time? Perhaps even approaching the point of being obsolete. At some point, will we have to write off some of this inventory? So oftentimes what investors and lenders will look at is the quick ratio, which says, let's take a look at the assets against liabilities, but pull the inventory out of there. We're going to do a more deep dive in the inventory, but for our purposes right now, take it out. And now we see that the quick ratio for the current year is 0.93. So you can see it drops substantially. So immediately that tells us what? It tells us that inventory was a big part of current assets. Again, not necessarily bad. It probably will require an analysis of the inventory to determine exactly how liquid it is. How viable is that inventory? So the important thing here is just to recognize that while, again, inventory are positive, it's something we own. It depends. It depends on the value of that inventory. Now, if I've made sense so far and we've gone over a bunch of ratios, let's just take another minute and see if that's generated any questions so far. And I can't hear you, Michael.
Can you hear me now?
I can.
A thousand apologies. I'll say everything quick again. Leave a thing in the chat or a comment. Can we go back to the I think the operating page real quick? When you had 7.1%, could you just go over that line again? 7.1 for, I think it was the operations page. Yeah,
The
right
operating
here.
margin?
Could you just, yeah, the operating margin? Could you just go over the second line again? I think you just cut out, and I didn't hear anyway the formula that got you to 7.1, but I heard everything else. So I
Yeah,
just
no,
thought,
no
well,
problem.
we would.
Operating margin is going to that's the margin that is after we've considered we've taken out COGS and looked at that. We're going to go to the next line where we're going to take out COGS and SG&A. So the formula here is EBIT, which is earnings before interest and taxes. So that's all the expenses, COGS and SG&A, but we haven't paid out any interest or taxes yet. And so that percent is 7.1. And it's going to be the only thing left to take out at this point will be the interest and the taxes, which we'll do in the net profit margin.
Awesome, thanks. And I haven't seen any questions coming in, so I think we can move on. But again, if anyone has any other questions, feel free to leave them in the chat or in a comment, and I'll get out of here.
Great. Okay, so let's get right back into ratios because I know you're excited to use your calculators again. And let's talk about operating ratios. Note that I've mentioned a couple times the importance of what kind of return we're generating. As a former president and CEO of a publicly traded corporation, I recognize the impact my decisions can have on generating returns for shareholders and owners of the business. We take the money and we spend it. What do we spend it on? We make investments. We invest in equipment. We invest in products. We invest in people. And why do we do that? Because we want to generate an acceptable return. So in operating ratios, we want to look at, while there are many more, we want to look at two key ratios that are of keen importance to owners, shareholders, lenders, and even suppliers. And that is return on total assets, the ROA, and the return on equity. So let's talk about return on assets. Again, remember, assets are things that we own. Why do we own them? Because we bought them. We invested money. And what are the assets that the firm has? If you go back to the balance sheet, excuse me, we have cash. We have receivables. We've made sales and we're waiting for money to come in. We have inventory. So we've invested in assets. And now we're talking about total assets, not current assets. So let's also include plant and equipment, facilities, the equipment we use in production. All of those have been purchased. We've made investments in those. Why? To generate a return. And so one thing that shareholders will be keenly interested in is what is the return on those assets that we invested in. So we're going to take, in this case, the net income. We're going to divide that net income by the total amount of assets, multiply that by 100 to generate a percentage. And we see that in the current year, our return on assets is 7.2%. Now, note that that is way up from last year, which was a negative return. In other words, for all the assets we had in place last year, we had a negative return on the application and use of those assets in the business. Now we're starting to be positive at 7.2, or that every dollar invested in assets is generating a return of about 7 cents. Now, could be good, maybe not so good. It's an improvement over last year, but are we on target for what our expectations were? Remember, one of the big things that management does at the beginning of the year is we put together the plan, the strategic plan for the business. And part of that plan is forecasted and projected financial pro formas. We forecasted what these returns would be. And so the first thing I want to look at internally is for the current year, 7.2%, how does that match up against what we budgeted? If we had budgeted, say, 5%, bringing it up from a -3, then we have met and exceeded the budget. But if we had budgeted 15%, we're way off. And again, the first initial part of every discussion on this would be why. Why is the return on assets 7.2%? And assuming that one thing I'm always going to look to do is improve performance, what can I do to ensure that we increase that as we go forward in the business? The other is return on equity. Now, shareholders are going to be very keen on this because equity, if you recall, that's their money. If we go to the balance sheet, we've got the assets at the top part of the balance sheet, things that we own. Then we have liabilities. Those are the things that we owe. And the difference between those is the money that belongs to the shareholders. Shareholders' equity. If we were to liquidate the firm today and sell off all the assets and use that money to pay off all the debts, the amount of money left is shareholders' equity. It's what they now have in the business. Now, our current year shareholders' equity is 12.8%. Last year was a -17. So again, substantial improvement year over year. And again, what does this mean? It means that for every dollar of shareholders' equity, it's resulting in a return of about 12 cents. Okay. What was our goal? What was our target? To be determined. And we're going to talk more about, is that enough of an analysis to do? And you're going to get a guess right now that no, it's not. Let's move on to debt. The discussion of debt or leverage. It's called leverage because we're leveraging other people's money to generate a return, to operate the business. We're going to be interested in two key ratios here. One is the debt to equity ratio. And we're going to look at debt to assets. So remember, debt is money that we borrowed, and equity is money that belongs to the shareholders. Assets are presumably those things that the firm invested in to support the business operation for growth and going forward. Now, let's look at the debt to equity. This is also known as the risk ratio. Why? The more debt you have, the more risk is inherent in the business. Now, what is the risk? What we talk about risk here is it's the risk of default. It's possible that you are so much in debt that the bank and or shareholders are sitting back and saying, if they are unable to pay that debt back, what happens? It's bankruptcy. And there's a huge cost to shareholders if there is a bankruptcy. So we want to monitor and manage our debt to equity. So here we're going to look at total liabilities divided by total equity. In this case, note that our total liabilities is 1.5 million. Our total equity was 1.9 million. So the debt is less than equity. And we have a debt to equity ratio of 0.77. And last year it was 0.83. Now I'm going to make this a tad more complex. Let's think about what this means. At 0.77, for every dollar of shareholders' equity, we have about 77 cents in debt. Now, a debt to equity ratio of 1.1. What does that mean? It means that there's a dollar in liability and a dollar in equity. So both the shareholders and the debt holders are on an equal level. It's 1-for-1. Now, that's not necessarily bad. And here's the challenge for business, especially between the executive staff and the financial group. How much debt should we hold? And that's a question that is analyzed constantly and is a big part of building the capital plan for the business. And we talked about the capital plan in Unit 1. The capital plan says how much debt and how much equity do we use to do the business, to conduct business. Now, debt is risky, but only if there's too much debt. How much is too much? It depends. We want to have enough debt so that we feel comfortable being able to, we have a good enough cash flow that we can monitor and take care of that debt. And remember, debt is to the advantage of the shareholders. As debt increases, the return on equity to shareholders increases. Why? Because we're using somebody else's money, not just theirs, to generate a return. And so that can have a positive impact. But we can't have too much debt because it increases the risk of default. The other interesting thing about debt is that the more debt we have, typically the higher the cost of debt. If you've ever been out looking for a loan, depending on your credit rating and the amount of money you're looking for, you can wind up paying a higher interest rate for that debt. So all of these are part and parcel of the discussion. It goes into how much debt, but we're going to manage and monitor that debt to equity very, very carefully. So having said that, we also want to know what the relationship is between the debt that we have and the assets. Remember that probably a good part of debt has been used to acquire assets that we're going to use for in the operation. So now we're going to look at our total liabilities and divide that by total assets. We now have a debt to asset ratio of 0.43. That's the current year. Last year was 0.64. It's gone down. Now, here, what this 0.43 means is that for every one of those dollars of assets in the 3.5 million, we have about 43 cents of liabilities. Now, the higher the ratio, the higher the potential for risk. Why? Because as that ratio goes up, it means that the amount of debt in proportion to assets is increasing. I think what happens at some point where the debt is greater than the assets, that's a potential issue with liability. So again, what is the right number? A lot of it depends on the business, what you're actually doing in the business right now. Are you in a growth plan? Are you in a maintenance plan, and what's going on in the industry? But we want to carefully evaluate and monitor the amount of debt we're using and the amount of assets that we're acquiring. Now, a couple more ratios that I think are very important for us to think about in our business, because it goes to what value are we creating? One of the key responsibilities of the management team in any business is to create value. It means, how do I make the business worth more week over week, quarter over quarter, year over year? Am I creating value for the owners and shareholders? And two key measurements that we're going to look at is the price to earnings ratio and the market to book value. Now, before we get into ratios, let's just talk about these terms for a minute. Price. What price are we talking about here? We're talking about the price of a share of stock. Now, the stock does not have to be sold in the market. I can be a sole proprietor, have no outside shareholders, but I can establish not to be traded stock. What is the price of a share of stock? If I wanted to bring in another investor and they wanted to buy 1,000 shares, what would we charge? So the price of a share of stock and the earnings. Now we know what the earnings are. It's the bottom line of the income statement. And so the earnings is, what is the earnings per share of stock? Suppose the earnings or the net income at the bottom of our income statement was $100 and we have 10 shares of stock. What are the earnings? It's $10 a share. All right, so we're going to look at the price to earnings ratio. What is the market seeing as the price, the value of that share of stock, and what is it actually producing in earnings? And there's some interesting things to consider here. And the second ratio we want to look at is the market to book value. The market value, again, is what does the market say a share of stock is worth? Remember, the price of stock is determined by the market. I don't get to set the price of stock for a share of stock in my company. The market does. The market is looking at performance. They're looking at competition. They're looking at what we're doing and what the future possibilities are for the firm. And they're making all those and putting it into a value decision and saying, we're going to value a share of stock at X number of dollars. The book value is the actual value on the books. Novel idea. What is the book? It's the balance sheet. What is the book value of a company? Take the assets, convert it to cash, pay off all the liabilities, and what's left is the book value of the company. It's shareholders' equity. That's what the company is worth. Now, if the book value of the company is $100 and you have 10 shares of stock, then the book value per share is $10. Now, if we've got the idea about what these mean, let's take a little bit of a venture here to doing some calculations on ratios. The price to earnings ratio. We're going to take the market price of a share of stock. Now, if this is publicly traded and you own any stock or you've looked at the market or the exchanges, you'll see that market prices are going up and down all the time. So we'll take an average market price per share and we'll divide that, what the market says a share is worth, let's divide that by the actual earnings per share. Now, in this case, our stock is trading at $12.17 a share. Earnings was $1 per share. So the price to earnings ratio is 12 times, or the market is willing to pay 12 times what the actual earnings per share are. Now, before I go any further, think about what that means. If the actual earnings on a share of stock is $1, why would the market pay $12 a share? Now, if you think about that a minute, there's only one reason. And that's because the market is looking at where the firm has been, what we're currently doing, and they're looking at forecast on where the company can go. And they obviously feel positive that we are going to do better over time. Now, last year, our P/E ratio was 9.7. It was less. So I'm going to guess that in the last year, we have done some things, improved financial performance, as we have, you've seen from the prior ratios. And so the market is feeling a little bit better about our stock. Now, when you look at the PE ratio, by the way, is commonly used by investors. And one of the neat things about the PE ratio is it doesn't matter about the industry. It's just an easy way to look at how the market views a share of stock and what it's actually earning. And it makes it easy for us to do some comparisons among competitive companies and even what the industry is doing. Now, a high PE ratio could indicate a growth stock. That's why it's paying a premium 12 times, 15 times. As that goes up, the market is saying, we feel really comfortable that this company is about to do substantially better. It's a growth stock. A low PE ratio indicates a value stock. What do I mean by value? It means that the market price for the stock and the returns are pretty comparable. We're not looking for any major growth in this. It's maybe considered a safer investment if you have no expectation of making a large increase or a large return. Okay, so you will see this ratio used very often when people are talking about a stock offering or when they're comparing opportunities to invest in various stocks. Okay, so price earnings ratio. And by the way, there is much more information in the course on exactly what these indicators are. And there's also a tremendous amount of information out there online on these. They're very, very common and very popular topics in financial management. The next is the market to book ratio. So we want to evaluate how the market is valuing our stock and what is that stock compared to what the book value is. So the market ratio is the market capitalization same. It's $12.17 a share. The total book value, remember, assets minus liabilities equals shareholders' equity, invested sales, expenses, projected cash flow, project margins. My question now is are we doing against the plan? Is it correctable? Do we have to make a change? Or here's one. Suppose that when we set a plan at the beginning of the year, like we again and restate our forecast. Maybe we have to bring the other parts of the forecast we had. If you're going to forecast less sales, we will need less equipment, less materials. We're going to compare the numbers to historical performance, and we're going to compare the numbers to what's taking place in our industry. All right, 3 kinds of comparative. To make a good decision, you have to spend the time up front to gather all the necessary data that you're going to need. Talk to all the people you have to talk to, conduct all the studies and the analysis, and then sit down and use that information to make a decision on any part of the business. And so as a former president and CEO, I can tell you Carrier, which is Disney company, which I'm sure service and customer response. Why? Because they were known as they have some of the generating a number and then moving forward. Generating the numbers is simply the starting point of what we're going to do. Now, in our next presentation, will we do anything else? Let me just go back to Michael and see if there's any questions so far.
No questions right now. I'll tell